In technical analysis, the trend is your friend. But for many investors, finding the right tool to identify the trend can be overwhelming. However, chart trader Rob Roy suggests that you start with the Elliott Wave Theory. In this episode, Rob will explain how Elliott Wave Theory can be used to help identify those high probability trades. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. And joining us today is Rob Roy, a chart trader who also mentors traders looking to improve their strategies and market understandings. Rob, it's great to have you here with us.
Great to be here, Brian. Thanks for having me.
Well, the first thing on the table that I want to ask you is what brought you to technical analysis?
That's a great story. I transitioned from a career as a golf professional into the world of finance, and I became a financial advisor. And as I'm sure you're probably aware, in the traditional world of finance, everything is fundamentally based. So all of my training was based on fundamentals. And one of the quips that we used to say is the best charts are found at the bottom of the ocean with the shipwrecks. And so everything that we did was based on fundamentals. And that's kind of how I started my own personal trading. And then I had the opportunity to run into a gentleman that started talking to me about this thing called Elliott Wave. And I have to admit, when he first talked to me about it, it went in one ear and out the other because, in my training, I'm all based on fundamentals. And then the transition occurred when he showed me a chart of the NASDAQ before 9/11, and it talked about the NASDAQ making really a move to the downside that seemed astronomical, like there's no way this could happen. And then, of course, 9/11 happens. The market's closed for 4 days. It reopens. And when the NASDAQ reopened, it went down and hit the target exactly where he had shown me. And that was my first thought of, well, maybe I should pay attention to technical analysis. And I started looking at Elliott Wave right from the beginning of technical analysis. I had a few other indicators in there, and I do still have a few confirming indicators. But from that point forward, I started looking at technical analysis. And then, as I think a lot of people do, I went 180 degrees. I went from completely focused on fundamentals to completely focused on technicals. And I'm not a technical trader that is negative on fundamentals. I think fundamentals still matter. So I think if you can have the best of both worlds, if you can set up a great chart pattern from a technical standpoint and it's backed by good solid fundamentals, it can't be anything but a positive. So I do lean more towards the technical side, but backed up by fundamentals. So I think you find the right mix there.
That's excellent. I thought when you originally started out, the story was going to say it started on the golf course.
Oh, I've had a lot of conversations on the golf course, and what I tend to do is just listen because some of the things that people say, you know that they're wrong or they're off base or they're doing risky things or whatever. So I tend to just listen more. But yeah, there's a lot of trading and investing talked about on the golf course. It's really truly amazing.
Well, that's awesome. I think we will dive into fundamentals a little bit later on. But first off, I want to have you explain to our audience what is Elliott Wave Theory?
Absolutely, and I think it's quite interesting. And if you don't mind, if you'll humor me, I'll give a lot of history. It was developed by a gentleman named Ralph Nelson Elliott, who worked for the railroads at the end of the 1800s. So I think that's important to show that this is a system that's been around for 125 years. And back then they didn't have medicine, so he got a physically debilitating disease. But he was known as a mathematician, and so as he was kind of homebound, he got interested in the markets and he became convinced that you could take what has occurred in the markets, so what's happened in the past, and use that with a reasonable degree of accuracy. They don't make any sort of wild, crazy claims like this is always right. Nothing's ever right 100% of the time, but he felt like you could use that, and then you could use the psychology of the masses, fear and greed, supply and demand. The markets are supply and demand, and traders are fear and greed. And so it's always a combination of those. So he felt he could put those together, and he created this mathematical algorithm. And in general terms, it believes that the market moves in impulses and corrections. In other words, the market doesn't move in a straight line for long periods of time. It can for short periods, but if it moves vertically, then you're going to have a stronger correction. If it moves more of a 45-degree angle, the corrections are less severe, but you're always having up and down movements. And I think what happens with people is when they're in a trade, it's hard enough to know when to get in, right? But the difficult thing is when to get out. Are we leaving money on the table? Are we getting out too soon? Did I wait too long? And so the basic premise of Elliott Wave to me that makes it so great is it gives you target prices both from support and resistance, and it helps on knowing when is a more ideal time to exit a trade, again, knowing that we're never going to be 100%. But that's the crux of it, is that you're taking the psychology of the masses, you're focused on supply and demand, and you're understanding that if you're in a long trade and it corrects against you, it's not necessarily a signal, I need to bail, I need to get out. It's all normal. The market moves up and down, and so wait until your target is hit. So that's a real general analysis of Elliott Wave.
But how would you apply the Elliott wave in your trading strategy?
That's a great question, and it's something that I feel like I do something a little unique, and that's what I'd like to share with the people that are watching. What you see out on the internet so often is the normal 5-wave pattern. You know, 1, 2, 3, 4, 5. The impulse pattern is 5 segments. And then once the wave 5 ends, you go into one of the 3 corrective patterns, which are flats, zigzags, and triangles. So that's what happens to consolidate once an impulse pattern has completed while you're waiting for the next impulse pattern to become identified. Now, the way the 5 waves work is the first wave is short covering. So normally if you're dealing, and we'll just talk about upward movements, but in an upward 5-wave pattern, you've had a downward move, and then there's a little period of short covering. That starts the first wave. And then there's a little bit of a corrective period in the wave 2 to the downside as the shorts aren't ready to give up yet, but they've lost control. The selling has been exhausted. And then you start up in the wave 3. And the institutions watch, and when the institutions see that the market moves above where the wave 1 high was, they come in, and they're known as the smart money, right? They're always in early. And so it's commonly viewed that wave 3 is the strongest of all waves. But what's incorrectly sent out to people in the world of Elliott Wave, in my opinion, is don't trade the wave 3, wait for the wave 4 to correct. So you let that strong wave 3, and everybody agrees it's the strongest wave because of what we talked about, Brian, price to volume. Institutions are big, they have big volume. So you get a big, strong wave 3, let that finish, let the wave 4 come in. And now if you let wave 1, 2, 3, and 4 occur and label on your chart, then you step in and trade the wave 5. And that's when the retail traders come in. But typically, retail traders are late to the party, right? FOMO that we talk about all the time, Brian, right? Fear of missing out. So they come in, but while the retail traders are coming in, the institutions are getting out. The viewpoint is if wave 1, 2, 3, and 4 have all done what they're supposed to do, then the percentage of wave 5 hitting its target is higher. So that's why people are taught wait and trade the wave 5. Well, my thinking was, well, wait a minute. If we all agree that wave 3 is the strongest of all waves, why are we waiting? Why not trade the wave 3? And so in trading the wave 3, there's actually a pattern. It's called a zigzag pattern. It's one of those 3 corrective patterns that I talk about. And what's unique is it's 3 waves long. Every single 5-wave pattern starts with a zigzag. And that's normally labeled A, B, and C. But what you see on your screen here is it's already moved to 1, 2, and 3 because again, every 5-wave pattern starts with a zigzag, but not every zigzag turns into a 5-wave pattern. So what I like to do is once we've identified that this is a wave 3, trade the zigzag. It's only 3 segments, so it's shorter term. And it gives you targets because the argument on the wave 3 is you don't know when the institutions are going to get out. When are they going to leave? So not only are you putting more percentages theoretically in your favor if you let the first 4 waves occur, but you don't know where the wave 3 is going to end. My viewpoint is let's not ignore the wave three. Let's embrace it. Well, how can we do that? By trading a zigzag, and it's only the three segments. Pure Elliott wave rules say every 5 wave pattern starts with one, so they're gonna be there. If it's in a wave three, you're gonna have a zigzag, and we have a realistic target price to get out, and it's worked extremely well. So I know it's a little different than the typical Elliott wave theory, but I've got a lot of history doing it, and it's been quite successful. So I would like people to, not just listen to the general rhetoric that's out there about Elliott wave. Take some time, do a little research, and I think if you take a look at this, you're going to find that, wow, that works pretty well.
I know you touched on it a little bit earlier that most traders ignore the fundamentals, but you feel a little bit different about that. Can you elaborate?
I think there's some sort of a viewpoint out there that you have to be on one side or the other. You're either a fundamental trader or you're a technical trader, and I just think that that's wrong. And I'm someone that has come from both. I was once completely a fundamental trader, and then I went to being completely a technical trader. And it just from a common sense standpoint makes sense that if you're looking at one of these patterns that I'm talking about from a directional standpoint, and that's the technical side of things, but that you can add in that it's backed by solid fundamentals, how can that not be anything but a good thing? So I do think that to be the greatest success you can be in the world of trading, it makes sense to incorporate both. Yeah, I think it's a mistake to just feel like you have to be one or the other. Why can't we be both? I think it makes common sense.
Yeah, I think the more inputs, the better, in my opinion. As long as you can make heads or tails, and it sounds like you have some good inputs that you use from both sides.
Well, I think you just made a great point there, Brian, is that don't get married to one indicator. And everybody's looking for the magic bullet, right? They want that one thing that's going to set them apart, that's going to make them a lot of money, and it doesn't exist. So don't get so, in my opinion, don't get so caught up in being focused on one indicator. Broaden yourself out and create a system. I keep going back to that, but I think having a system, even if you just focused on technicals, if you have a system, that's better than just focusing on one indicator. But I still think that if people will take their technical system that they believe in and back it by solid fundamentals, they'll find out that it's helpful and it just makes them a better and more successful trader.
Let's move on to something else you could trade, which is options. Talking about options, what should traders consider when selecting a particular option?
What an amazing question and a big mistake. I mean, what you've identified, Brian, is one of the biggest mistakes that traders make. And options trading is the fastest growing. It's the, in fact, only area in the United States that's growing. People are becoming more interested in options because of leverage, right? You can control more shares with less money, and so that's an appeal. But the mistake people make is they buy at the money options. Like if they're used to trading stocks, and just to use round numbers, hypotheticals, if you got a stock trading at $100 and they start to become educated in the world of options and they think the stock's going to go up, they're going to buy a call option. What call are they going to buy? They go right to the 100 strike, the at the money strike, because they're used to buying the stock at that price. Well, the at the money is where the majority of retail traders trade, and that's where the greatest amount of extrinsic value exists in the options, the greatest amount of time value. And the negative on options is you have to be right in a reasonable amount of time because time decay is the enemy when you're buying options. So this is something that I thought about in the shower, and it's the delta curve. Now, in the Greeks, delta tells you how much money an option will make or lose on the next dollar the stock moves. Once the stock moves a dollar, the delta changes, and it changes based on gamma. And gamma is simply, in simplified terms, the speed at which the delta moves. And when you look at this, what's on your screen here, you can see the delta curve is a lazy S. It's not linear, right? From bottom left to upper right. It doesn't move in a 45-degree angle, which is what you would naturally assume here, that you go up and you see where the at the money option is. If you're right, okay, the option gains value pretty quickly. But look how fast it loses value if you're wrong, because you're right smack in the middle of the curve. Well, first of all, you're halfway through the vertical part of the curve, and you can see that it starts slow. So when you start down here at 0, the delta takes its time, but right in this curve area here is the 25 to 30 delta. So it's a little ways out of the money. But look, if you're right on direction, how vertically the delta goes up. So if you catch it here and you're right on direction, you're gaining the greatest acceleration of the delta, which is gamma, as it moves up. But if you're wrong, you can see you're going down the curve on a much, you know, less steep slope. It's almost flat. So in general terms, you make money as fast as mathematically possible. Again, no guarantee. We're talking about the Greeks, right? So we're talking about if you're right on a trade and you started at this delta area, the option will make money as fast as mathematically possible as the math formula for delta works. And if you're wrong, you'll lose the slowest possible, because you're down here. And if you start at the money where the average retail trader does, you're going to lose money just as fast as you would make it. So if you're right, you make money, but you've already taken away half of the vertical nature of the move. And if you're wrong, you lose money quite quickly. And then you're finding so much time decay. The greatest amount of extrinsic value, which is time and volatility, is in the at the money options. So another benefit, if you go further out of the money and start right at the bottom of this curve, as I'm talking about, there's less extrinsic value there. The options are cheaper. So then one more step, Ryan, is because they're so less expensive, depending on, and everybody should have their own risk management, right? You should all have your portfolio management. You should only be putting so much money of your portfolio at risk in any one trade. But because the options are cheaper out of the money, you can buy more contracts. Well, then you take the number of contracts times your delta, and you'll find out that your net delta by doing this is higher than if you would have come up here and bought a 50 delta. So if you buy even two, and sometimes you can buy 3 or 4, but let's just say you bought a 30 delta and you can buy 2 of them for the same cost as one at the money. Well, the at the money option's a 50 delta. Well, you bought 2 of them at a 30 delta, so the net delta for your trade is 60. So you're going to make 60 cents on the next dollar the stock moves versus 50. And that blows people's minds sometimes. So people make mistakes of when they first start to learn about the Greeks, and they get away from the general major mistake that the retail trader makes when they first learn options, which is buying at the money options. They go the wrong way. They learn a little bit about delta and they think, oh, let me buy an in the money option because it has a higher delta. Well, let's look at the other side of the curve here. If you're buying up here and you're right on direction, look how slowly the delta moves. So you're not getting any benefit for spending that extra money that is going to cost you to buy that in the money option. And now you fall off the entire cliff if you're wrong. So you put more money at risk on the one option. You're not going to gain value from gamma. The delta is not going to accelerate very quickly. And if you're wrong, you can lose a lot of money in a short period of time. And it's the biggest mistake people make, Brian. They go the wrong way. They get a little bit of education on the Greeks, delta and gamma. And I would like to have people take a look at this and practice, right? Paper trade. Anytime you're learning something new, don't jump in and throw money at it. Learn it. You got to learn about it. But it works so much better. And that's a true story. I was literally we always talk about you do your best thinking in the shower, but I was really thinking about the delta curve one day in the shower, and it made such a tremendous difference in my trading on how I was buying more contracts for less money. If I was wrong, I was losing money slower. If I was right, I was making more money. And it's a little counterintuitive though, right? If you're looking at a 25 or 30 delta versus 50 or 75 or 80, it kind of takes you a while to really grasp the concept of, in the end, you're going to make money faster. But that's an amazing question. Glad you brought that up, because it's one of the biggest mistakes I see people make. And we're having people move into options every day, right? Because it is growing so fast.
Well, I've made a lot of mistakes that you've already mentioned, but what are some other common mistakes you see traders make?
We learn from our mistakes, right? And there's an adage out there that you learn more from your mistakes than you learn from what you've done that's right. And it's because it hurts more, right? Especially when your money as at risk. And a lot of the things that I share with people is from my own mistakes. I've made them all. I mean, I made them all. I got to the point where I wanted to learn so much and I absorbed everything that I could learn. And one of the biggest mistakes is thinking you know more than the market. And I made that mistake. We've talked about some of the other ones on being wrong on the Greeks and, the exits of getting nervous if your trade starts to go against you, you have a profit. And it is true, the worst possible thing that can happen is to have a profit in a trade and have it turn into a loss. But you also have to be cognizant of the fact that the stock's not going to go your direction forever. So withstand that, have the patience and the discipline to trust your system, even if it's going against you. So the biggest mistake people make is trying to follow some sort of a risk management system so tightly that they don't allow the pattern to play out. So whether or not people want to embrace zigzags within wave threes as I do, or whatever system they're using, I just encourage them to spend the time to practice at it, understand it, know it, get good at it, and then trust it. Otherwise, you're just going to slowly wipe yourself out. But so practice trading, paper trading. I'm not one, Brian, that believes paper trade forever, because there's a different psychology when it's in a paper trading account. We can be very disciplined, right? When it's not our own money. But when our own money is at risk, then the emotions come in. And that's when we tend to violate our systems and we panic. And so I'm a believer, practice until you learn it. But then as soon as you can, put a small amount of money at risk. Don't go, diving in the deep end, but put a little bit of your actual money at risk so that you can understand how the psychology changes when you're trading and it's actually your money at risk. Because people learn so much and then they panic and they block out, they go blank and they just can't take the fact that it's not going the direction that they should. So it's not easy, but it's doable for everyone.
You really have to actually be aware of that there's so many different emotions that are going to come up when you're trading on paper money where it's not your own money. I know I've done that at a certain time when I first started out in trading. I was doing 20 or 30 contracts at a time, and mainly they were really unrealistic trades. So then once you move to trading for real, it's a totally different ball game. So I'm glad you made that point, because once you do trade for real, the emotions are totally different, and you do have to have that as a major consideration.
And I think one thing that I would encourage people, and this is a mistake that I made, Brian, as I became more educated and knew that I knew more, I used to think I should be able to hit the exact bottom and the exact top. And if I got out and then the stock continued higher, then I'd be angry. I'd be like, I got out too early. I should have stayed. Look how much more I could have made. And that's unrealistic. Nobody hits the exact bottoms and the exact tops. What we're trying to do is catch a piece in the middle. That's where you're going to have your most success. And if you were happy with the profit that you had, this is something that, keeps you in the game. If you're happy with the profit that you made when you close the position off, even if it continues higher and you could have made more, don't go back and second guess yourself. Monday morning quarterbacking is easy. Be happy, be content. I made a decision. I'm confident. I was happy at the time. I don't care what happened after that. And that took me a while to learn that one concept, Ryan, of realizing that nobody's perfect. Nobody hits the exact bottoms and the exact tops. And how we become successful is let other people try to do that. Let's just take a little piece out of the middle, take our chunk of gain, and move on. And when people start to have that mentality, I think they become far more successful.
Yeah, for sure. I've learned to do that also myself. You just go ahead and pat yourself on the back. If you have any profit at all, it's better than no profit. So realizing that, if you have any success on the trade, you don't want to get greedy, you don't want to hold it too long, but any profit is better than no profit. And thanks so much, Rob, for all of your informative insights that you've shared with us today. I think our audience is really going to enjoy our conversation and get a lot out of it. But for our listeners wanting to learn more, where can they find you?
Website, ewotrader.com. In fact, what I was showing with the Delta and Gamma there, is in our education area. We have tons of education on both Elliott Wave and the Greeks and other technical indicators as well. So ewotrader.com, and you'll see my smiling face right there.
All right, we're going to have to leave it there. Thanks so much for showing us Elliott Wave Theory, Rob, and how it can work to help identify market trends. Any final thoughts before we let everybody go?
Well, first of all, thanks for having me. I enjoyed it, and I can talk Elliott Wave as you probably heard for hours on end. And I just would encourage people to don't give up, don't quit. And that's a pretty common cliche, but it happens a lot in the world of trading. I've seen it so often where people start, they don't have success, and they give up. It just means you need to practice more or learn more. But I just want to encourage everyone, you don't have to have a Harvard MBA to be a successful trader, but you do have to put the time in. It's not easy. There's rules to follow, there's education to learn, but you can do it, and everyone can enhance their lives, whether they just want a little extra income or they want to trade for a living. Don't give up. Keep moving forward. Keep learning, and you'll be successful. I fully believe that. Everyone can do it.
All right, Rob, great words of advice. Thanks so much. And thanks everybody for joining us. For those in our audience, make sure to check out our full lineup of educational content. We have instructional videos, interactive masterclasses, and courses and more live webinars. Register now to continue your learning journey. And until then, see you all next time. Have more questions? Check out the links to the right and in the description below.